Budget preparation is a critical management accounting activity that transforms organizational objectives into detailed operational and financial plans. Effective budgets depend on reliable forecasts, particularly sales forecasts, because sales volume often drives many other aspects of organizational planning. Within the program framework, forecasting techniques such as time series and trend analysis help managers estimate future demand and prepare realistic budgets. These forecasts provide the foundation for the master budget, which integrates all functional budgets into a coordinated organizational plan. By linking forecasting with budgeting, organizations improve resource allocation, planning accuracy, performance management, and strategic decision-making. Time series analysis is a forecasting technique that examines historical data over a sequence of time periods to identify patterns and trends. Management accountants analyze past sales figures to understand how demand has evolved and to predict future sales volumes. Historical data may reveal recurring patterns such as growth trends, seasonal fluctuations, cyclical movements, or irregular variations. By studying these patterns, organizations can estimate future sales with greater confidence. Time series analysis is particularly valuable when historical performance provides a reliable indication of future demand. The technique enables managers to produce evidence-based forecasts rather than relying solely on intuition or subjective judgment. Trend analysis is a specific component of time series forecasting that focuses on identifying long-term movements in sales data. A trend may indicate increasing demand, declining sales, or relatively stable performance over time. Management accountants often use statistical techniques such as moving averages, trend lines, and regression analysis to identify underlying growth patterns while smoothing short-term fluctuations. Once the trend has been established, it can be projected forward to estimate future sales volumes. Trend analysis helps organizations anticipate market developments, plan production capacity, allocate resources efficiently, and establish realistic revenue expectations for future budgeting periods. Sales forecasts generated through time series and trend analysis form the starting point of the master budgeting process. The master budget is a comprehensive collection of interrelated budgets that translates organizational objectives into detailed operational and financial plans. The sales budget is typically prepared first because expected sales volumes influence production requirements, inventory levels, staffing needs, purchasing activities, and cash flows. An inaccurate sales forecast can therefore affect the reliability of all subsequent budgets. For this reason, organizations devote significant attention to forecasting techniques and market analysis when preparing their budgetary plans. The master budget consists of several operating and financial budgets that interact closely with one another. Key operating budgets include the sales budget, production budget, direct materials budget, direct labor budget, manufacturing overhead budget, selling and administrative expense budget, and inventory budgets. Financial budgets typically include the cash budget, budgeted income statement, budgeted statement of financial position, and capital expenditure budget. Each component supports a specific aspect of organizational planning, but none operates independently. Changes in one budget often require corresponding adjustments throughout the entire budgeting system to maintain consistency and accuracy. The interaction between budget components is one of the defining characteristics of the master budget. For example, the sales budget determines expected demand, which directly influences the production budget. Production requirements then drive materials purchases, labor scheduling, and overhead planning. These operational budgets affect inventory levels, cash requirements, and financing needs. The cash budget consolidates expected inflows and outflows to assess liquidity and funding requirements. Ultimately, all budget components combine to produce the budgeted financial statements. This interconnected structure ensures that organizational plans are aligned and that resource requirements are identified before implementation begins. Effective coordination among budget components provides significant organizational benefits. Integrated budgeting improves communication between departments, ensures consistent assumptions, and reduces the risk of conflicting plans. For example, production managers must coordinate with sales teams to ensure sufficient inventory availability, while purchasing departments must align procurement schedules with production requirements. Finance personnel use budget information to assess funding needs and monitor financial performance. Through this coordinated approach, organizations improve operational efficiency, enhance resource utilization, and support achievement of strategic objectives. Budget interaction, therefore, plays a crucial role in organizational planning and performance management. In conclusion, time series and trend analysis provide essential tools for forecasting sales volumes and supporting the budgeting process. By analyzing historical patterns and long-term trends, organizations can develop more reliable sales forecasts that serve as the foundation for budget preparation. These forecasts drive the development of the master budget, which integrates multiple operating and financial budgets into a unified organizational plan. The interaction between budget components ensures consistency, coordination, and effective resource allocation throughout the organization. Together, forecasting and master budgeting enable organizations to plan proactively, manage performance effectively, and achieve both operational and strategic objectives.